Okay, it is the last panel and the concluding panel of the whole forum, and I have two great minds, both professors and business schools, which is and it's my privilege to introduce them to you to sort of wrap up all the discussions throughout the day and give us some perspective into the future and where we go from here to the future. And I would like to introduce first Andrew Karolyi. He has many, many hats. And of course, most important hats that he has, his hat for being a husband, a father, and a grandfather. Then the hat being the Dean of the College of Business. And then I think the third most important hat that he has is being the chair of the board of directors for CIBA. And he has many, many other hats. If you just Google his name, you'll find so many international affiliations. It's terrific. And he's also a terrific and a prolific and very influential author in the field of international finance. And I'm amazed, being such a great administrator of the College of Business, he's also able to publish and to continue to publish important research on in the area of international finance, including how it affects international flows and international investments. So, Andrew, or maybe I should introduce the other speaker.
Steve, yeah.
The other speaker was not initially planned. We had the executive director of the New York State Economic Development Council, but he had to stay in Albany today for an important legislative meeting. So thank you, Stephen Altman, Professor Altman from New York University, who is a senior researcher and also director of the DHL, how is it called directly? Initiative on Globalization. So I would invite both of them to provide a perspective to what we talk today. And Andrew, maybe you'd like to start sharing.
You want me to go first? You sure?
Yeah.
I mean, I think we should let Steve go, but I'll say a few words. So I have been coming to these conferences now for the 10 years that we've been in existence. I never fail to learn, and I'm sure you have felt the same way as I have. I guess I'm giving my concluding remarks here. But I thought a little bit of framing might be helpful, and I'm going to bring a little bit of knowledge from scholarship into this, infuse it into this conversation, where we've heard from CEOs, newly founded small, medium enterprises, government agencies, multilateral organizations, as well as just thought leadership in general from the industry. But some framing might be helpful. The focus here is really about innovation, and certainly the theme of the last panel is infusing my thinking on this a great deal. There's a massive amount of research in the world of business and management on innovation in general. The global perspective on that research is a subset of it, right? A lot of it is in the US-centric, US-focused, but so a subset of it looks in the global dimension. And then I would say yet another smaller subset, it focuses on really the theme at the core of CIBA, which is on cross-border trade and investment. So I'm sort of giving you the ladder, the research stack, if you like. Here's what we know. I'm going to give you a 1, 2, 3 punch. And it's a little bit biased, but who cares? So what we know is, and you heard it in the question I asked in the first session, if you remember what I asked. What we know about innovation, patenting technology, all of the R&D spend that is part of corporations in corporate America and all over the world. What we know at its core is that nothing happens without robust financial and economic development at its core. Fact number one. The study I can cite for you is Xu, Tian, and Xu. It's a Journal of Financial Economics 2014 paper. It's one of a number. It's probably one of the earliest ones. They looked at 32 developed and emerging markets around the world, dozens of individual sectors, and they looked across decades. This is the kind of perspective that can inform the conversation you hear from the individual that's starting a business and talking, as Chang Sam did, talking about the importance. The core of his theme was the importance of having a stable, steady regulatory infrastructure that allows him to launch his business, right? So what this research says is that not only do you need the framing and the infrastructure, but you also need to have better developed capital markets, both equity and debt markets, that spur on economic growth and also can spur on innovation. And so this cross-country analysis does that. It's particularly acute in the finding of this study. It's not my study, it's their study. In sectors that are considered more dependent on external financing. So you've got to put the two together. And it's particularly focused on those countries that have a higher concentration of sectors like technology sector that are more dependent on external financing. So not internally generated financing, but the ability to depend on it. And you need a good rubric, a real important institutional framework for those economic systems to function well, to sponsor and spur on the innovation. So that's fact number one. Second one, cross-border M&A. So we're getting into the cross-border stuff. So another study looks at cross-border M&A and role of innovation. It's a very cool study. It's 2 years old, 23 years old. Journal of International Money and Finance. Xu, Huang. Yeah, I'll tell you afterwards. You come up to me and ask you, I'll give you the citations, I promise. So this study looks at almost 86,000 cross-border mergers and acquisitions. Think about the companies that have been on the stage today. How many of them were involved in acquiring other companies along the way to foster their inorganic growth? So 86,000 deals involving deals across 57 countries. And so here's what we find is that where the rewards are greatest are among the most innovative of acquirers that are domiciled in the least innovative markets and countries where the infrastructure for patenting and R&D spending are weakest, the most successful in terms of those abilities within that weak environment. When they go abroad and seek an opportunity to acquire another firm or another asset, and they typically will go into countries that have better rubrics, better regulatory frameworks to protect AI and all of this sort of innovation technology. When they trade up as they go abroad to acquire, and typically are seeking higher targets, higher innovation targets, that is where the rewards are the greatest. And the rewards here, forgive me, financial economist, we often measure the rewards from the shareholder perspective. I know it's narrow. It should be broader than that, but forgive the financial economist. We look often at the shareholder returns to the acquiring company in and around the announcement, and to look at the pop in the stock price that comes. By the way, those rewards, short-term financial rewards, turn into longer-term rewards in terms of spurring on even that much greater investment in R&D and patenting technology. So again, in the cross-border world, again, regulatory infrastructure, critically important. I'm setting you up, Steve, actually. I'm setting you up. Critically important as it motivates how an acquirer that pursues an opportunity outside their country of domicile, how important it is as a driver of that decision-making and the rewards that might come to the decision if pursued. The final one, I'll make it real short. It's a research study that I just published with two of my former PhD students who are now very senior faculty members at other universities, with Rose Leal here at Rutgers, Gilberto Loureiro in Portugal. It's in the Critical Finance Review, just came out. Our focus is on serial acquirers, platform acquirers. Never heard about those before. These are companies, and you know these company names, that are very aggressive acquisitors. They buy lots and in sequence, and often cross-border, but not just. What we focused on in this study is what we call extraordinary acquirers. Extraordinary acquirers are ones that not only do this serial acquisition activity, but they do so successfully. Again, forgive the financial economist. We measure the share price reactions to the announcements of the acquisitions, and we look across the platform of acquisitions they engage in. So imagine a company that's aggressively pursuing opportunities, doing it in sequence and a bunch in a fixed period of time, and the shareholders are cheering them on at every stage along the way. We call those extraordinary acquirers. Okay, there are actual serial, yes, it's true. There are serial acquirers who are not extraordinary. In fact, there are serial acquirers that are extraordinarily bad. Those exist too. Imagine there are firms who continually get booed by their shareholders, but yet now, notwithstanding, continue and pursue acquisitions. So we look at that contrast. That's the object of our study. We were shocked at the incredible prominence of the US in terms of extraordinary acquirers. They disproportionately dominate the globe in terms of the extraordinariness of their acquirers. And I kept saying, like, why is that? What's going on? And we tried to go through a number of different explanations of why the US is a special place. Guess what we landed on? A lot of the themes that you heard at this panel all day long. The incredibly important regulatory infrastructure in support of technology, patenting technology, the USPTO that Grant was talking about, others maybe complain about, maybe the overreach of it all, but that rubric, that the integrity of that regulatory environment, probably supported by a robust capital markets, is what allows the US to distinguish itself in being the home, disproportionate home of these extraordinary acquirers around the world. Furthermore, we followed up and looked at the extraordinary, yes, fewer of them, but extraordinary acquirers in other countries around the world. And what we found is, again, high level of intangible assets, high levels of assets that focused on patenting and R&D expenditure, the capitalization of R&D. So what's common here is the importance of innovation and patenting technology as transforming the way in which flows happen around the world. And the regulatory infrastructure is such an important part of sort of what guides it all. End of mini lesson. How long was that? 6 minutes? 10 minutes? Sorry. Now I think I set Steve up here.
Thank you very much. Now, Steve, let's continue with you.
Thanks very much. It's an honor to be here and to follow the dean, and also to be the last speaker, an honor that is probably best handled by being fairly brief. So my research focus and what I've really dedicated about the last 15 years of my work to is measuring globalization, really trying to understand how are the flows between countries changing? Are they growing? Are they shrinking? Are different countries interacting with different countries? And so this work that I've been doing, sponsored by DHL for quite a long time, I lead a small research team at NYU Stern that produces this long-term series of reports. We started in 2011, called the DHL Global Connectedness Reports. What we do is we measure patterns in trade flows, capital flows, information flows, and people flows, both the size of the flows, how much crosses borders, and which countries interact with which other countries. We look at it over time for the world, by country, by region, and so on. Happy to give out the reports, also available free online. To try to be most useful for all of you, what I'd like to do is try to connect what we are doing in our research with three of the themes that were prominent in the conversations today. We had a lot of talk about onshoring or domestication. It's happening in some industries, but how big is it really? Want to show you some data on that. Second, The possibility of nearshoring regionalization. Is business shifting, still crossing borders, but is more of it happening among proximate countries? I'll show you some data on that. And then third, we didn't get as much talk, but there was some about what people often call friendshoring. So shifting from doing business with adversaries or rivals to doing business with countries that have more friendly relationships. Those are three big shifts that kind of were infused in today's conversations. I'd like to show you some data to put them in perspective, and then talk about a couple of implications very briefly, if I may. Many of the graphs in the report have interactive versions online. I'll just use the online versions to show you a few pieces.
Yes, you need them.
Okay, if I grab a stand as well. All right. So the first of those possible shifts that we talked about was domestication or onshoring. So how much are we seeing shifts from activity crossing borders to happening more within countries? And we measure that in 14 different kinds of areas, but I will just highlight a couple of them. And the big picture story there is we really do not see that globally as the major pattern of what's going on. If you look at the balance of how much activity, trade, capital, information, and people flows, how much happens internationally versus domestic, it's actually pretty stable. So it had been going up in general up till 2022. Since then, we're basically holding steady at the high that we reached there. A lot of talk today was about trade. This graph here is the share of all of the output generated goods and services around the world, how much serves foreign markets. That's down a little bit from the peak, but it's really pretty close. So the maximum, if you take account of supply chains, maximum was 22%. We're currently at 21%. If you look at greenfield FDI, how much companies are spending on setting up new operations in foreign countries relative to global GDP, fairly volatile, but fairly steady. If you look at what share of M&A transactions cross borders, also pretty steady. These are just a couple of examples. Now, how does that perhaps, that seems like it contrasts a little bit, for example, with what we were hearing about onshoring batteries, onshoring semiconductors. When I try to explain why do the trends in the global data look different than what a lot of people are talking about, there are 5 reasons in the report. 2 of them are what I call strategic industry bias and big country bias. The strategic industries, semiconductors, batteries, they make the news the most. The global economy is more or less what we're showing on the screen. So we have to remember there are a lot of other industries that are not seeing generally this pattern of onshoring. Another reason is what I call big industry bias, a big country bias. What's happening in the United States, China, and also Russia is a little bit different. So if we look, for example, here we take total exports, share of GDP, world, it's close to a record. If you take United States, so all these graphs are interactive, they're free online for anyone who wants to use them. So we do have some declines in US versus the peak. It's a bit more complicated, imports versus exports, won't get into it, happy to follow up offline. But big picture view, globally, the share of activity crossing borders is holding steady. It's not declining. We don't see a general pattern of shifts from international to domestic activity. The second possibility that got a fair amount of attention in conversations today was the idea of bringing things closer. So nearshoring, regionalization. And here, again, the data really do not support the view that that is the main story of what's going on. So here, let's start with trade, and I'll emphasize that the most here. So this is trading goods globally. The gray line here on the chart is the share of global trade that happens within roughly continent-sized geographic regions. So you can see that that was, we did have a period where it was going up a little bit, up through 2020, but since 2020, that share of trade happening in regions has been going down. That actually depends a lot on where you draw the region boundaries. Be skeptical of any kind of analysis that just uses that way of measuring it. The yellow line here is the average distance in kilometers traversed by all trade around the world. It gives you a simpler picture. It's at a record high. So we do not globally have a pattern of trade happening over shorter distances. Once again, there are exceptions, different stories happening in different parts of the world. 2 years ago, I was saying the United States and North America is an exception where we have regionalization going on. You can see the gray line was going up for the United States. Yellow line was going down. So US trade was becoming more regional, happening over shorter distances. Last 2 years, the pattern reversed. So immediately after COVID, we did see North American trade, and United States dominates the region, becoming more regional in its trade pattern. That has been unwinding over the past couple of years. Greenfield FDI, gray line again, share is happening within regions. That had been becoming more regional up to roughly the COVID pandemic. Regional share going up, distance going down. That's also gone in the opposite direction. So be skeptical if people are just telling you it's becoming more regional. Check the data. Some industries, yes. Some industries, no. Globally, that's not the general pattern of what we see. Friendshoring, the story is quite a bit more complicated, and maybe I shouldn't go too far into it, but in very brief about it, there are two big separations that are going on in the data: US, China, and Russia, separation from Western countries since the full-scale invasion of Ukraine. And so, as many other studies point out, you do have a pattern of flows happening over shorter geopolitical distances. So less happening between countries that have more fraught geopolitical relationships. The trend in geopolitical distance, measured based on UN voting patterns, is the yellow line here. You can see a decline. Yes, there is some evidence that's for trade of friendshoring, but 89% of the decline since 2021 is due to only trade between the United States and China and trade involving Russia. The gray line takes those out, and you see there's actually very little of this friendshoring happening around the rest of the world. So that's a very brief way of talking about how we really need to check the data on these things. There's a lot of talk about deglobalization. There's a lot of volatility going on in politics and in policy, but actual business patterns show globalization to be quite resilient. The biggest implication of that, I would suggest, and happy to discuss further, is simply that the kind of activity that many of us are involved in and that we're discussing in this room is still really valuable, because most markets around the world are not closing down. There are still a lot of opportunities for growth through international business. Thank you.
Thank you. Thank you, Steve. Now, I have just one simple question for both of you. What are your, not three, maybe not two, but if you can list one big takeaway from all the discussions today, that would be great. And then we will open the floor for discussion.
My one-word takeaway is optimism. I heard it especially on the first panel, and I heard it over and over again. Companies not retreating from international markets, not retreating from the globe, but rather managing the risks and opportunities of a more complex world. Optimism to find solutions and to carry on. Optimism is my key word from this session.
Good. And I'll add relevance. I believe that this topic of this Center for International Business Acceleration, the topics that embed within it, the work that is done by those who are party to this are extremely relevant. And I'm really grateful to you, Elena, for organizing us every year. It's an incredible amount of work. I know everybody in this room will join me in appreciating all of the work that you do. But I also want to make sure that you all know, including the ones that have left, that the fact that you are here, that you are engaging with these topics is so important, because if you hear people talking about deglobalization and that this is all yesterday, and global trade and investment has completely disappeared and the world is completely being transformed, and I think that the truth serum of the DHL Competitiveness Index affirms, as you stated, that the work of this center and those that come and join and be party of it is incredibly relevant.
Thank you. Thank you, Andrew.
Thank you.
Okay.
To you, Elena.
Okay. Let's see if we have some questions, comments. Oh, okay. David Dornish, U.S. federal government coming here from Washington, D.C., and Cornell alumnus, doctor, yes, David. U.S. Accountability Office, right?
Sorry.
U.S. Accountability Office, yes.
We have an international affairs and trade division that I just wanted to see if either of you.
The question is what turn what you've been saying, Steve and Andrew, into a policy relevance. I think that would be the way to summarize your question. I have stepped, and you could probably Google some of this, into some noisy debates and discussions where people have accused me of lots of things about my politics. With regards to policy, I am a strong believer in the integrity of a strong, robust institutional framework in support of capital trade and capital flows. I believe that the U.S. has been the paragon for many economies around the world. Yeah, you're surprised, but you shouldn't be surprised. And there's a lot of objective research and evidence in support of this. You probably see it in some of the ways in which I talk about research. It sort of infuses the research. I think a lot about the resilience and the importance of institutions that render confidence. Trust is another thing that came up regularly today, that establish the trust in markets and the trust in a market economy and support thereof. So I would say if I were advising a policymaker, I would say that with all the noise about tariffs and debates thereof, what we can't lose sight of is the importance of the governance systems that we have listed, from the Securities and Exchange Commission to the Public Company Accounting Oversight Board, the Government Accountability Office, GAO, that run the gamut. So the integrity of the institutions that ensure the vibrancy of our capital markets and of our economic systems, I think that is something that we cannot lose sight of the importance of all of that.
Thank you. Steve, do you have?
So my specialty is measuring globalization. I'll offer an answer that's grounded in that perspective, which is to say, there are a whole lot of problems that arise from a whole lot of different causes, and the extent to which we need to address the problems with policies that are globalization related should really be grounded in those kinds of globalization measures, particularly the international share of total activity, the kind of first measures that I was looking at. So if you have an issue where international activity is a high share of what's going on, it's quite likely you're going to need to do something regulating international activity. On the other hand, if international activity is a small share of what's going on, probably it's domestic policy that needs to address the problem. In the United States, I think we often have a pattern of placing the blame on the international activity for the issues that need domestic policy solutions. The United States, naturally, we've had a lot going on recently in terms of imports. The US, if we look at the data, is among advanced economies, this is the economy that imports the least relative to its size. In fact, last year, there were only 4 countries worldwide, they're named in the report, I don't remember offhand, that imported less of all countries around the world relative to the size of their economies. So that suggests a lot of the concerns that we currently have regarding trade, we probably need to be addressing in domestic policy. mobility, upward mobility, social safety net, and so on, related policies. There can be exceptions. There are certain industries where trade's a big part. And then, it's also important that we look at the questions that are now being raised that relate to resilience, supply chain, supply, and so on, that I look at this mainly from an economic perspective. And I say, okay, the share that crosses borders is relatively low. We have to focus mainly on domestic. Supply chain perspective looks at, well, how much gets lost if you cut one of those chains? So you have to manage both perspectives, but that would be my general take.
Thank you. Oh, we have one more. Okay.
Looking at it in terms of, maybe I could offer quickly two perspectives on this. Looking at it in terms of value added, I think is really useful. And I didn't show any value added stats. We have a little bit in the report. One of the most striking things in the value added trade analysis that we're showing currently is that while we have a huge decline in the share of US imports that comes from China based on direct trade, the share of value added that originates in China and comes into the US so let's say if you take all of the foreign content that's used in the US economy, what percent comes from China? The most recent year for that is still 2024. We don't have 2025 yet, but by 2024, it had not actually gone down yet. So looking at these things, so the share coming in directly from China was down from a peak of 22% to I think it was 13 last year, now 9, or 13 in 2024, 9 in 2025. We were holding steady through 2024 on a value-added basis. So it's really important to be looking at what are the intermediate links, because you have a lot of components that originate, materials that originate in one country, get built into a product someplace else, and give you a different, really different view of the interdependencies than you have if you just look at the normal statistics. In terms of policies regarding localization or diversification, my general take is that we, particularly if it's a competitive market and we don't have a regulation or a subsidy that's protecting us from foreign competition, being pretty open is important to being competitive. So, if you're a competitor, if you're in an industry that's not getting unusual protection, so you're not in semiconductors or something like that, you pull back from international business, you need to be wary of what about your competitor who might not be doing that? Mm-hmm. So if that's the general view, I think what we need to be careful of are risky interdependencies, risky overdependencies. So I want to be looking at diversification, but diversification within reason, because diversification tends to be costly. So making sure it's not a sole source, making sure it's not a sole source adversary. So taking these kinds of more measured steps would be my general view, and happy to talk more offline.
Thank you. Thank you very much. With this, I would like to close this last panel. Thank you.